Miners are stacking, ETFs are stacking, and now even governments are in the mix. So why the price dip? Does it even matter? Stick around to find out here on The Effect. Hi, I'm Nate Martin, and this is the Bitcoin Effect. Bitcoin miners are starting to look less like forced sellers and more like vaults. For the first time in a while, the economics have shifted. Instead of liquidating their rewards just to keep the lights on, more miners can now afford to hold what they mine. Marathon, one of the largest public mining companies in the U.S., just announced plans to raise up to $850 million, and not to stay afloat, but to grow their Bitcoin reserves. And that's a shift in mindset. It means they expect Bitcoin to outperform cash, and they want to stack while margins allow it. Blockmate is following a similar path. They've secured a 200 megawatt site in Wyoming with ultra-low energy costs, just 3.3 cents per kilowatt hour. And even before the site is fully online, they've seeded a new Bitcoin treasury wallet using fiat raised through private placements. They're not waiting around for mined coins to start stacking. In both cases, we're seeing a strategy shift. Now, these aren't just operating companies anymore, they're becoming Bitcoin reserve entities. And that supply is coming off the market. And if more miners follow that lead, the sell pressure we've historically seen from this sector may fade away entirely. Institutional demand isn't slowing down either. ETFs and corporate treasuries now hold more than 10% of all Bitcoin that will ever exist. That's more than 2.1 million coins, and that number keeps growing. Recent filings show that daily inflows into U.S. spot Bitcoin ETFs have been outpacing new supply by more than 10 to 1. In other words, for every Bitcoin that gets mined, more than 10 are being bought up by institutions. They have to meet quarterly targets and they have to fulfill client allocation mandates. So this isn't hype buying. Now it's built into the system. And that structural demand keeps climbing while supply is getting tighter. If miners are holding and institutions are buying faster than new Bitcoin is being created, with that kind of tension between supply and demand, at some point that pressure has to show up in the price, doesn't it? And it's not just private institutions making moves. The U.S. government is on the verge of taking its own position in Bitcoin. Back in March, President Trump signed an executive order requiring federal agencies to study and report on whether the U.S. should establish a strategic Bitcoin reserve and how it might be structured if implemented. Well, the 180-day review period is now complete, and the public report is due out on July 30th. It's expected to address how seized Bitcoin is custodied, how digital assets are accounted for on federal balance sheets, and whether Bitcoin has a long-term role in U.S. Treasury planning. And while the report hasn't dropped yet, the fact that it exists at all is significant. It signals that Bitcoin is no longer something Washington could ignore or dismiss. It's looking more likely that it'll become a part of the national playbook. Real quick, if you like this kind of breakdown, no yelling, no hype, just straight Bitcoin signal, then give it a like so others can find us too. We first reported back in May that Pakistan announced plans to allocate surplus energy towards Bitcoin mining. Well, that means the government is positioning itself to not only explore Bitcoin as a reserve asset, but as a way to turn excess power into economic value. The Finance Ministry has since confirmed plans to allocate 2,000 megawatts of surplus power to Bitcoin mining and AI data centers as part of the country's broader energy strategy. And that's a massive scale-up, especially for a country still negotiating the terms of its financial recovery with the IMF. The move hasn't been without controversy. While initial reporting suggests the IMF opposed the plan, both the IMF and Pakistan's power division later clarified that discussions are ongoing. It's still unclear whether the proposal will ultimately align with Pakistan's broader loan agreement. What is clear is this: Pakistan sees Bitcoin mining as a potential export industry. By monetizing surplus energy that would otherwise go to waste, the government is positioning Bitcoin not as a threat, but as a tool for development. And that puts them in the company of places like Texas, El Salvador, and parts of Africa, regions where Bitcoin has become a key to unlock the door to a global financial conversation that they've been locked out of for years. So when Bitcoin pulled back from $119,000 to around $115,000 this week, it didn't feel like panic, it felt like noise. Because if miners are stacking, ETFs are stacking, and sovereigns are seriously considering long-term reserves, then maybe the bigger question isn't why did the price dip, but why isn't it higher already? If supply is thinning and structural demand keeps building, the price won't stay stagnant for long. It may not move in a straight line, but everything we're seeing points in the same direction. And that's why, even after this recent dip, it still feels like the signal points up and to the right. That's it for this edition of the Bitcoin Effect. If you've enjoyed this episode, hit like, consider subscribing to the channel, and ring that bell so you don't miss what's next. We'll see you next time.